We're going to be talking about a company that we have not covered here at Chip Stock Investor.
A new one. It's a popular one right now too. So expect this to get hundreds of clicks. And we could literally make tens of dollars on YouTube.
No, we won't make that much.
We won't. No, you're right. We won't.
Tens of cents.
Let's talk about the company.
We're going to be talking about Flex.
Formerly known as Flextronics. I like the abbreviation.
Yeah, it's much simpler. It falls into the contract manufacturer section of the semiconductor supply chain. Flex takes care of the manufacturing for a bunch of different things, which we're going to talk about here in a moment. But this is one of the reasons that we're talking about it right now. As you can see, Flex has been doing pretty darn well since last year. But then in May, just last month, you can see there was an inflection point and the market cap has skyrocketed.
Yeah, you gotta love those 80% returns in a month. April and May were pretty epic.
We analyze this business with the help of our friends over at fiscal.ai, and they are the sponsor of today's video. Fiscal provides deep analysis tools like this slide right here, helping us understand the revenue breakdown. And we're going to be talking about a spinoff that Flex is doing. And so being able to see these revenue breakdowns and seeing where that revenue might be going to their spinoff is very helpful when you're analyzing a business.
Make sure you check fiscal.ai out, and you can get 15% off any paid plan using our special link in the description below or on the screen, fiscal.ai/CSI. Check it out, 15% off.
Now, last year we did a video talking about OEMs and ODMs. OEM, original equipment manufacturer, and ODM, original design manufacturer.
There's also a third one not on this list called an OBM, original brand manufacturer. That would be someone like Tesla or Nike that manages some in-house manufacturing itself, but might also use some outsourced manufacturing services as well.
And Flex fits into that middle circle there, EMS or electronics manufacturing services.
Yeah, it's an outsourcing manufacturing service. As we showed you in the first slide here, Flex competes with some companies that have become pretty familiar in recent years. Foxconn, of course, the global giant based in Taiwan, but with operations all over the world, also manufactures all sorts of stuff. Some other fellow North American competitors, Jabil, Celestica, and Sanmina. Sanmina, of course, being of AMD fame. After AMD made that acquisition of ZT Systems last year, and went ahead and spun off the manufacturing portion of ZT to Sanmina. So that's, generally speaking, who Flex competes with. And so how this works, companies that have in mind what they want to make but need some help designing the products, they also need help managing the manufacturing supply chain, will hire an outsourced manufacturing service like Flex. And you can see why you would want to choose a company like Flex. Quite the diversified range of operations across a lot of different countries.
And when you think about a manufacturing company, perhaps you think outsourced manufacturing, Asia. That equates to Asia. There is a lot of manufacturing in Asia, 19 million square feet, 40 plus locations. But Flex is actually very well diversified all over the globe. Europe, Middle East, and Africa, 11 million square feet, 35 plus locations. And even in the Americas, there's 7 million square feet out of 18 million in the United States.
Historically, outsourcing to a country where labor is cheaper has been decades now, something that people in the United States, I think also probably in other markets in Europe, have complained about. Companies taking jobs away from the local market and moving it to someplace like China, Southeast Asia, or especially India in recent years. But because technology has advanced so much, there are more robotics happening on the manufacturing floor than ever before, more automation, and so it requires less human input. So basically, fewer people, regardless of where they live, are getting that job. The robots are taking over, and that tends to actually increase the cost parity over time. And so a lot of manufacturing, this kind of coincides with why we're seeing a lot of this onshoring and friendshoring in recent years. Because the cost parity is narrowing, there is more manufacturing taking place in more diversified locations than just those historically lower labor cost markets in Asia.
Now let's get to some interesting news. And one of the reasons that the market cap we showed you earlier had such a big run up in early May. Flex announced that they are intending to spin off their cloud and power infrastructure segment into a new company, which is yet to be named, is referred to as SpinCo in the following slides. And this is something that Flex has done before. Previously, in 2024, Flex spun off Next Power,
which has worked out marvelously. Next Power has been a fantastic integrated solar system design company the last couple of years for shareholders.
And now they're doing this power and thermal part of the business, which we're going to take a look and see how that's been performing. So here's a quick look at these two portions of the business, the proposed spinoff on the left and what will remain of Flex. Fiscal year 2026 just ended in the end of March. And so now we're looking into fiscal year 2027, but $6.6 billion in revenue for this portion of the business, power products and thermal management. And what will remain is a bigger part of the business. $21.3 billion will be the regulated manufacturing solutions and integrated technology solutions.
Let's break this down a little bit further. Let's start with SpinCo on the left. What is cloud power exactly? What are we talking about? Let's start from the left. Critical power products. This would be power systems for utility companies, power distribution units for data centers. Middle left, embedded power products. This would be subsystems within a server in the data center. So providing power to the individual chips, also power to the individual shelves within the rack. Middle right, thermal management. That's super exciting. We talk a lot about a company like Vertiv that not just does power solutions, but also thermal management, taking away that heat so that the chips don't cook when they're operating at increasingly higher power levels. So actually, Flex would be like an outsourced manufacturing service for a company like perhaps Vertiv or some of the other electrical system and cooling system names in here. And then far right, cloud. You might think that would be the actual servers themselves and the racks themselves. But actually, this segment of the business is going to be focused again specifically on providing power to those trays and the racks themselves. So utility companies, hyperscalers, neoclouds, and so on, power and thermal management specifically.
And you can see why this is of such interest. This is actually the much faster growing part of the business. 38% year-over-year revenue growth in fiscal year 2026. And then those other two numbers on the right, the expected revenue growth in fiscal year 2027, 65 to 75% revenue growth. And then in fiscal year 2028, over 80% in year-over-year revenue growth. One of the biggest reasons that this is such a great deal, spinning off this part of the business with such high revenue growth, is they can consolidate market share. This is an acquisition that was made by Flex Electrical Power Products in May, and this is going to be part of that new spun-off company as well. As they continue to consolidate and gain market share in this part of the industry, it's shaping up to be a really well-positioned business when they spun it off.
We'll come back to this at the end, but this is becoming a key theme to this bull market is these old industrial conglomerates breaking up into smaller, more focused businesses. So this SpinCo, in keeping with the trend, with the theme of the day. But before we get to that, let's talk about the remaining Flex business profile. There is still actually going to be some outsourced electronics and communications manufacturing going on. Some of their big customers that outsource to them, Cisco, Juniper Networks, now part of Hewlett-Packard Enterprise, Solar Edge, even though they spun off Next Power, there's still some solar business here, Teradyne. Kasey, you had mentioned that one segment within Flex called Regulated Manufacturing Solutions. That would, of course, be healthcare and also healthcare devices, automotive, also pretty highly regulated industry for safety. Not pictured on this list. You can see all the way on the far right there of this slide, Flex mentions lifestyle. This would be even companies like Nike. Flex signed a deal with Nike, I think it was originally about a decade ago, where they were going to start manufacturing Nike shoes with some of the same automated electronic manufacturing equipment that is used to make everything from servers to wearable devices. The results for Nike to date have been pretty mixed. It's also meant that Uyghur children are out of a job. So this joke is going to land flat, isn't it? This is offensive.
We shouldn't have to explain a joke, I guess. But the reason that Nike got into that position where they needed a company like Flex is because they got into some serious trouble.
The dark side of outsourcing.
Exactly. The dark side of outsourcing. They were using
child labor.
Nike was, in fact, using child laborers in China. And so they finally decided that wasn't a good idea. So they decided to go with a company like Flex.
Yeah. Now no one gets a job except for the robots.
Exactly.
But sometimes that's a good thing. Anyways, this is a pretty diversified business. They decided to stick Nespresso on this slide instead of a company like Nike. Fair enough. U.S. apparel companies are in a world of hurt right now. Anyways.
BT Dubs.
Yeah.
Under Armour and Steph Curry are no longer together.
Not a surprise that they parted ways.
He's moving on.
Okay, back to Flex. This remaining larger part of the business, pretty sleepy, basically didn't grow last fiscal year that just ended in March, but they think it will grow somewhere in the range of low to mid single digits in fiscal 2027 and fiscal 2028, the period that lasts through the end of March, calendar year 2028. That said, here is a look at Flex's segmented revenue. At the tail end of fiscal year 2026, you could see a little bit of a heat up in that legacy business, regulated manufacturing like healthcare and auto, and integrated technology for customers like Cisco and HPE and so on, low teens year-over-year revenue growth. But this business does have lower profit margins. This is a hallmark of outsourced manufacturers. Typically, they have low to mid single-digit profit margins. Historically, in past years, this part of the market hasn't been all that lucrative for investors, but there is some actual margin improvement going on as the technology improves and automation starts to actually make profit margins more lucrative and attract investors in, thus the stock run up. I'd expect that this continues to trend upwards, maybe towards high single-digit adjusted operating profit margin in the coming years.
But on the other hand, cloud and power down there at the bottom in green, you can see that the adjusted operating margin is significantly higher, nearly 10%, and their operating income year-over-year growth was 30%. So significantly different and much more profitable.
Yeah, and as you mentioned earlier, getting ready to grow 70 to 80% over the course of the next 2 years.
No joke. Here's just another way to look at this to help you visualize what is the growing segments. In blue, integrated technology. In orange, regulated manufacturing. Both of those have been relatively stagnant over the last few fiscal years, but cloud and power infrastructure in purple, the growth driver.
And here's the consolidated business, both the Flex part and also including the SpinCo. By the way, that spinoff should be completed by the first quarter of calendar year 2027. So within the next 9 months, you can see the recent trend upwards in recent years towards mid-single digit operating margin on a GAAP basis. And the SpinCo, that's the really lucrative bit of this investment, is going to be much higher, perhaps nearly double the operating profit margin. You could argue because it's a cyclical business, because this part of the economy is doing very well, they're perhaps earning more money than average, than they will on average over the course of the long term. We're just going to have to see how that plays out over time. But there you have it. This is a pretty good trend, even though the margins are not typically what you would want to look for in an investment. But with that kind of trend in the right direction, maybe this could be a great long-term buy and hold. Maybe.
Yeah, Flex will no doubt focus on improving their margins once they get that spinoff complete. And here's a look at their balance sheet. Total cash in green and the long-term debt is in red. Actually, a really decent balance sheet for a manufacturing company. A manufacturing company usually has debt on balance, but they have plenty of cash to balance out that debt.
That'll come in handy, especially for the SpinCo, as it probably will be looking to consolidate market share via some bolt-on acquisitions. And then finally, on valuation, here at the tail end, this is probably a bit disappointing for some investors to get to this last slide and to see.
This is where we're going to get a YouTube comment that says, I wish you would talk about companies before they run up.
I guess That's always a problem, though. If that were the case, we would just never talk about any stocks ever. But we'll have to see what the valuation looks like for the remaining larger portion of Flex versus the SpinCo when that happens within, let's say, the next 9 months, and where we see the actual revenue and operating margins at the time of the spinoff. But the higher valuation is not super surprising, especially considering that the SpinCo, which is roughly a third of the revenue, but a bit more of the actual operating profit, is expected to grow 70 to 80% in each of the next 2 years. I mean, not a real shock that this would trade at a high valuation. But let's say maybe on a forward basis for the next year, we're looking at something like 60, 70x earnings, and then maybe that even drops further closer to maybe 30x earnings for fiscal year 2028. So this is definitely a momentum play, but as we mentioned earlier, this is kind of in keeping with the theme these days. As technology has advanced, there's more automation. A lot of these manufacturing services now have what looks to be robust profit margins. Maybe this is finally a more attractive place to invest for the long term. So this is of interest. Obviously, there have been some big success stories around this in recent years. The GE breakup, GE Vernova. This has done obviously really fantastic since we first talked about it 2 years ago, almost exactly. We've over on Semi Insider have talked about Amphenol, the acquisition of CommScope, and the continual breakup of Vistance Networks. We have another one coming up with Honeywell here in the next few weeks. All of these have done quite well. The era of the big industrial conglomerate, managing everything from microwave ovens to cable networks so that you could just continuously drive earnings beats quarter after quarter, those days are finished. It's time to be smaller and more focused, and that is what Flex is trying to do here. Looks pretty good, at least on paper.
My interest is piqued. Make sure you check out fiscal.ai/CSI to get 15% off any paid plan. And if you want all of our research, come on over to chipstockinvestor.com. Make sure you watch this video that we just recently put out about software communications companies.